Hey everyone, before we do the market rundown, just want to remind people that we've got our free course posted about it on social media, but if you missed it, I'll put the link in the description of this video or in the comments. It's a free course, Introduction to Technical Analysis. It's targeted towards people just getting their foot in the door or perhaps some skeptics of technical analysis, and it's free, no credit card, no nothing. Sign up, take the course, win. Let's go. Checking in on commodities. Tomorrow's going to be a big day. FOMC, 2 p.m. Eastern, is going to have a significant impact on the dollar, gold, and miners. Oil inventory report, 10:30 p.m. Eastern is going, 10:30 a.m. Eastern, is going to have a significant impact on oil short term. So starting things off with the dollar, I'm watching the range that we are trading within between 98.28 and support of 96.46. And we're looking for a lower high to be set compared to 98.28, but the bulls have done a pretty good job bouncing the last 5 days. If we get a bullish reaction to the dollar, to the FOMC, we're going to look at 98.37 as the highest price that we've seen recently. That's going to be a key resistance level. As you can see, after 98.37, not a ton of clear resistance on the weekly time frame. If it is a bearish reaction, we're looking back down at 96.46, and we'll look at an equilibrium tightening range as we head into next week. The bulls for gold have been loving how well they're holding up in the face of the dollar seeing a pretty solid bounce on the daily time frame. So we have a daily uptrend still intact with gold. We were unable to see continuation today, not surprising, patiently waiting for the FOMC tomorrow. If it's a bear reaction, we will lose the daily uptrend, and we'll zoom out to the weekly chart to look for a weekly higher low to form. Anything above 1269 is a weekly higher low, so the bulls have a lot of space to work with. If it is a bull reaction to gold, to the FOMC, we're going to be looking at these two resistances, 1366 and 1375. Because we have already broken one of these monthly resistances in this 2-year-long tightening range. And if we can get over 1366 and 1375, it's a lot more convincing for the bulls that we're breaking out, as opposed to just breaking one level and stalling out a little bit. Keeping in mind that this is the monthly time frame, and it takes a while for these moves to play out. The daily uptrend is clear, and the bulls are comfortable with the fact that even if it's a bearish reaction, we're still going to look to maintain weekly higher lows and that uptrend. So the bull miners have been on quite the run. And at this point, we have seen the leveraged ETFs obviously go even further, but 17% move. So we're looking at 50% plus on NUGT. And again, as we've been covering, just with how these setups are, the junior miners are very often weaker than the senior miners. If I'm looking bullish in miners, I'm looking at NUGT and GDX over GDXJ and JNUG. So we have a higher low pattern every single day, the last 6 days. If we lose that pattern, we'll look to consolidate and form a higher low compared to 22.24. If we see a bullish reaction, we're going to zoom out to the longer term time frames here as well. And we can see we're already breaking a few levels, but we'll look at 24.86 and 25.58 as the next major levels. Same thing as gold, bearish reaction. We're just going to be looking for a weekly higher low to form. GDXJ, also anything above 29.89 is a daily higher low. And looking at the comparison on the monthly time frame, we can see this monthly chart compared to the senior miners on the monthly chart is night and day. And the biggest difference is a trend change, higher low and higher high for the senior miners. And GDXJ is not even close, 35.04. We need another 10% move to even get to resistance. So that just is a perfect example of why the senior miners are stronger. Oil had a very bullish day today. And we had our high, or I should say our low, high, held support, and now we're looking up at resistance. We're going to change the daily trend if we get a bullish reaction tomorrow to the inventory report, and we're going to stay in a tightening equilibrium pattern if we get a bearish reaction. So a bearish reaction will be a lower high, and we'll look back down to 50.59 support. And with a bullish reaction, it's the first daily confirmed trend change in over a month, and we would then zoom out to the weekly chart, and we would still be looking for a weekly lower high to form, but it would be a notable shift in momentum that would only help the S&P 500 bulls who are hovering just under that all-time high. I personally flipped oil bearish today through DWT, the leveraged ETF for the bears, just a half-day maker trade, but I looked at this hourly chart, I saw how extended we were, I knew 54.80 was resistance up ahead that was unlikely to break. I looked at the 15-minute chart and saw how extended it was. So I said to myself, when we lose the 2-minute uptrend, which is clearly favoring the bulls at this point, when we lose the 2-minute uptrend, I will enter bearish, just looking for quick consolidation, just looking for a 5-minute higher low or a 15-minute higher low, and locking in a short-term day trade. So we pulled back. We had a little support level at 54.02. We held it at 54.04. And as soon as I saw that little double low, I said, okay, that's the level that I'm watching. If that breaks, I go bearish. It broke, entered bearish. We faded. And again, I was not in this trade long and covered before we saw this secondary leg down, but it was just a nice little move. And that's just an example of how I will use overextended moves. I'll look in the other direction for a quick scalp, and I'll use the short-term time frames to show me that first little shift in momentum. Natural gas bears in control. We knew the daily trend change with no follow-through was a red flag, because a trend change with no follow-through, you zoom out and look for the potential of a flag, and it is a weekly bear flag on NatGas. So we're looking down at support of 2316, which is, it broke by 1/10 of a penny, still technically holding. But if that level breaks, we're right there, 2297, and that would confirm the weekly bear flag. Bears still in control. Lots of rejections from 240. Looking at it on the 4-hour time frame, candlesticks struggling to get over that level and hold it. That's where we stand as we head into tomorrow. Again, if you are holding into the FOMC, just fully accept that you're gambling to a certain degree. And it's very high risk, high reward with earnings and with reactions to inventory reports and FOMCs. I know I'm not putting in dozens of hours of fundamental research to give myself an edge over other traders or the market as a whole, so I don't try and kid myself and think that I have an edge. If I were going to choose to play these events that lead to very volatile reactions, it's flipping a coin. And if I were going to do that, I would go to Vegas and play roulette a bunch. And I don't do that. I want the odds in my favor. So I personally sit out these events because I can just wait for favorable setups and try and lock those in consistently long periods over time, as opposed to what I feel is a bit more like gambling. Appreciate you watching. Hope you have a good rest of your night. We'll see you tomorrow.